Welcome back to the IB Investor channel. In this video, we'll take a look at Vitrolife and its most recent quarter. We'll cover a short introduction of the company, the share price development, the sales and the profitability, the cash flows, the debt situation, the return on invested capital and return on equity, the dividend yield, and history. Vitrolife is a Swedish-listed medical technology company which sells products in vitro fertilization, primarily culture media. Vitrolife was founded in 1994 as Scandinavian IVF Science AB. It would merge with Ex Vivo Transplantation System AB in 1999. The company was listed in 2001 on Nasdaq Stockholm. Now, the company currently holds a 20.8 billion Swedish kronor market cap. It trades at large cap under the ticker symbol VITR. The industry is within medical equipment, and the owner are primarily Bure Equity and Demand Invest. So you can see here on the bottom as well the different ownership structures here in capital. So quite big owners here of this company. Now, this company has done very well for itself since inception here. We can see that shareholders who held it for the long term here has made 2,600% here, which is quite massive. However, they would have done much more had the stock stayed at these levels here at 585. But later in this video, we're gonna see how much overvalued this company worth this time. But now for this year, it's been in decline, and actually for the 3-year period here as well. So here we can see on the right side the total return, which includes dividends reinvested here. And we can see for many periods here, for the 3-year period and 1-year period, it's actually down here. However, for the 6-year or 5-year period here, you actually made 6% here, including dividends. Can also mention here during this time, I don't remember exactly when, but this company also spun off Ex Vivo. The company also is listed on the Swedish Stock Exchange, so they have distributed some special dividends here in terms of extra companies here for shareholders. But we can mention from the top levels here, the stock is down roughly 74% here from the top. So quite a massive change in terms of share price here for the short term here, and obviously holding it here for the decline period, you probably lost a lot of money. But again, shareholders who held it for the long period has made quite some good returns here, and even for the 10-year period there's been almost 10x here with dividends here included. So very good returns, at least for the longer period. But in the short term, it's been pretty awful to own this stock, and pretty rough ride here then for the shareholders. Now for the income section or income statement section here for this company, we can see on the blue line here the net sales here, and the net sales has grown pretty well with a short decline here in 2020. So this was basically the time where we had the COVID-19 and a lot of the hospitals and so on, these facilities where they conduct these fertility assistance sort of thing, closed down or shut down during this period. So they lost some sales here, as we can see. However, they also acquired quite a big company here in 2021, and that's shown probably here in the figures as well. However, for the EPS, we can see that the EPS has grown pretty nicely over the time here in orange, but the decline here has happened in 2020, and it has not recovered from its 2019 levels here, 3.5 kronor. So here we only have 3 kronor. There's been some dilutions here of the shareholders here that we're gonna watch in the next few seconds here or minutes here, but the EPS is also down here, we can see, and it's never recovered. The gross margin here currently at 55.6% here for the rolling 12 months, and it has been higher in the past. So here in 2014 it was as high as 68.4% here, so much higher compared to today's 55.6. Also the profit margin here at 11.6 is much lower than that of 2018, where they had roughly 26.9% here, so more than half currently compared to this period. So quite a big difference here in profits as well. So
This company has the potential to make a lot more money as they've shown in the past, but yeah, we'll see if they'll get back to that level, but certainly in the past they have, so it should be possible. But these levels here are quite low then, even for the periods going back here for many years. So it's not just an off year here in 2018 where they had almost 27%, but it's been at those levels here, almost here, as you can see, in 2019 as well, and also in 2017. It looked like 2015 was also quite a good year here for the profit margins. So management has some job here to return to those levels, certainly. Now just a quick overview here for the growth of the company and sales. So we can see that America is currently down here at -8%, which is negative, of course, and this is also quite a big area here of 33% of the total sales. However, we can see here in EMEA that it's up 14%, which is very strong, and then Asia Pacific here plus 5%. So in total 3% plus. So quite weak, I would say, but you know, it's certainly here Americas which is dragging everything down here. We won't dwell on this too long, but here we can see the gross margin here. So the US or America here kind of explains why the gross margin here is so low overall. So it's less than 50% here, whereas in Asia Pacific it's actually, you know, 63% here. So there's a big difference here in this region compared to the US or Americas here, where they have to bring it up. And we can also see here some of the other margins here, but it's much lower for for the market contribution in total compared to Asia. So they're doing very well in Asia, but it looks like America's margins are just way lower, which is dragging everything down. And then we have Europe here sitting at middle, making some good margins here, but it's certainly Americas that we can see here, which is, you know, in decline and also bringing the margins down here, unfortunately, for this company. Now for free cash flow margin here, and we can see that the company currently has a 18.6% margin, which is actually pretty good. However, we've seen in the past that the margin has been higher, as high as 28.9, almost 30% here at 2017. So very, very good free cash flow margins here. But you know, 18.6% free cash flow margin is still good for a company, so it's nothing, you know, to look down on or anything, but it's just that they have performed better here in the past, and also here in 2020 they did perform a 27% free cash flow margin. However, here in 2021, I'm not sure if this is associated here to the acquisition that we're gonna look into in the next minute here, but they made a big acquisition here in 2021, and that's probably the reason why the free cash flow margin here is it just looks like it's, I don't know what it looks like, but it's just funneling down here a lot. And then comparing it then to Celavision, some peers here at 9.6%, and also Elekta here at 0.2% here. So some peers, just for apples to apples comparison for this KPI. Now this paints pretty much the same picture here. So they posted a 4.8 free cash flow per share here in terms of kroners in the most recent quarter, trailing 12 months here, and then currently the company trades at a 3.14% free cash flow yield. So quite a low yield, I would say, but it's not the lowest I've seen. But yeah. And now for the cash flow overview. So it's pretty difficult to see all of these bars because of these massive drags here in 2021. But in the blue here, we can see the cash from operations growing quite nicely over the years, and has actually kept on growing, which I like to see personally. However, there were some decline here from 2019 to 2020 and 2021, but here in 2022 it did pick up again, so this is good to see. And we can also see that the capex here, or the spending or the investing side of the business here, the orange part, has been much lower here in the past, and also here in most recent time here. But again, some acquisition here that they probably made here that we'll look into, but I think they spent 1.48 billion US for this when they bought it from EQT, and the acquired company was called, I'm not sure exactly how to pronounce this, but Igenomics or something like this. So quite a big acquisition here that they made.
So several billions of Swedish kroners here they spent, and it's shown here as well, I think, in the investing part of the cash flows here. Now for the share count, and I think they did pay with some shares here, it looks like. So the acquisition happened here in 2021, so probably some of the shares were used here. As we can see, it went from 109 million to 150 million, but here we can see 135 million, so quite a big change here. So from this number, 109 to 135 is roughly 24% increase in terms of number of shares that the company have outstanding. So quite a big dilution here for the shareholders owning this stock. So and this was mostly done through this acquisition of Igenomix, or however you pronounce the name. So I would assume that some equity was actually used in terms of shares here to pay off for that acquisitions, and not just, you know, paying it off with cash. Now for the net debt versus the operating cash flows, and we can see here that the net debt were actually negative, which is very good. This means that they have more cash than debt currently. However, here in 2021, when they made the acquisition here, we can see that they took on some debt here to finance that acquisition most likely. So here we can see that the net debt spiked here to 1.7 billion Swedish kroners here. And we can also see here that the cash of operations keeps on growing pretty nicely here. And we can also see that the net debt is actually going in the right direction. So quite a big decline here year over year and year over year again here. And we can also see that the gap is being reduced here between the cash from operations and the net debt here. So this is exactly what shareholders and speculators like to see, that this gap is not increasing, but rather we can see that the net debt is going down here. And we can also see that the cash from operations are going up. So, you know, at some point here in a few years is probably going to meet, maybe in the next year even, depends how good of a year they have in the next year. So, but it's nothing alarming right now. We can see that they can pay off all the net debt with the cash from operations in less than 2 years. So nothing alarming right now. But when they made the acquisition here, it looked pretty alarming, I would say. But this is looking really good right now. Now for the net debt to EBITDA, and this pretty much paints the similar picture as we saw previously here, where, you know, the net debt is going down, and we can also see here that the multiples are coming down as a consequence. So currently at a 1.2 times multiple, which is, you know, it's not zero and it's not negative, but 1.2 in my book is certainly nothing alarming, especially since the cash flows from operations look pretty strong and growing pretty nicely. So nothing alarming, I would say. Obviously here we can see that it has been negative because they had no debt previously. So, you know, I'm sure that they want to get back to this situation here, but as of now, this multiple is nothing to be alarmed of in itself. And we can also compare it here to some peers, Elekta at 1.5 times, and CellaVision at 0.0 times here. Now for the enterprise value to EBIT, and we can see that the company currently trades at a 32 times multiple, which is still kind of expensive, I would say, but it's certainly nothing like 89 times here, as we could see, you know, in 2021 when the company was massively overvalued and the share price were, you know, exploding, so to speak. So the company has come down much in value, but looking back here in 2014, 2015, the company has traded at much lower multiples in the past. So the question is whether or not the multiples will go down, or whether, you know, the underlying business will catch up with this multiple going forwards. It's tough to tell. I can't tell, but this 32 times multiple is nothing that I would say would be a bargain or cheap, so to speak. So the value proposition of this company is quite expensive, I would say, right now. And then also comparing it here to some peers, Elekta here at 20.1 times and CellaVision at 25.4 times. So even the peers are actually trading at a little bit higher multiples than I'm used to, but I would assume that medtech perhaps is one of those, you know, areas where shareholders value these companies a little bit higher, or investors, compared to perhaps, you know, some regular industry companies and so on. Now for the return on invested capital, and this whole page is basically management's performance here.
So we can see that the return on invested capital here for the most recent years is very low here. So at currently a 2% here for the most recent quarter. But in the past year, it's also been quite low here, 2% and 1.9%, which is super, super low. However, here in the past, if we go back a few years, we can see that the percentage has been much, much higher. So management has a business here that can perform much better, but it's just the capital allocation here of the management that has to improve here. And we can also see the return on equity pretty much paints a similar picture here. You know, very low single digit numbers here for the return on equity, but in the past it's been much higher here. So certainly this, you know, company should have the potential here to come back to, you know, double digits and you know, in the 20s, early 20s here, percentage for return on equity as well. But it all comes down to management's allocation of capital here to drive those returns. And currently it's, you know, kind of mediocre. I'd say, you know, a 2.3% it's not good right now. Now for the dividend side of the business, and we can see that the company has paid a dividend all the time. Actually, on the right side is probably better to look first. So they only stopped paying a dividend here in 2019, but except for 2019, and that would be paid out in 2020, mind you. So this is the COVID-19 year. But other than that, they have actually paid a dividend for all the other remaining years here with a quite a good, you know, dividend growth here for the early period. But now it's been stagnant here at 0.8 to 0.85 kroners a share here with you know, no sign of picking up some speed here in terms of share dividend growth here. But we'll see. This company has produced some very nice cash flows in the past, so if they can get back to, you know, growth again, this company could be, you know, increasing the dividend again. But we can see here certainly that it hasn't grown for a couple of years here, so they still, you know, are at the 2018 levels still today here for 2022, which was paid out here in 2023. So kind of disappointing. However, for the dividend yield here, we can see that it's a much better value proposition today, as we see in the low levels here at 0.29% here, 0.25% here, going all the way up here to 0.56% here. So more than doubling the yield here just because the share price went down here, and also including some dividend raises here. But the dividend raises here are quite small, you know, so nothing special. So this is more likely, or certainly only because of the share price reduction here, the decline in share price. So it's just a better value proposition, but I'm not saying it's a good value proposition right now, just that the share price went down. So the yield is a direct consequence of that right now. All right, guys, so this was enough for this video, and this is, you know, recorded with my most recent purchase here, a new microphone here. So I hope the audio quality was a little bit better. If not, please let me know. But anyways, please like the video and hit the like button if you like the video, and subscribe to the channel if you like more content. Thank you very much. Bye.